This episode is brought to you by TruStage, an insurance and financial services provider built around the philosophy that a brighter financial future should be accessible to everyone and the businesses that serve them. Their products and solutions help people confidently make financial decisions that work for them at every stage of life. Visit TruStage.com for more. Hello, and welcome to a new Fintech Takes podcast series, Lending Unbundled, sponsored by our friends at TruStage. This series is going to be about the consumer lending market in the US, and specifically how it's changed over the last couple of decades. If you were to go back in time and take out a loan 20, 30, 40, 50 years ago, the experience you would have would be very, very different as a customer. As you're going to hear in this episode, it all used to be with one institution, whether it was a bank or a credit union or perhaps a trust institution. You would go in, you would fill out paperwork, you'd sit across a desk from a loan officer, you would be approved or declined. If you were approved, your loan would be booked, funded, it would be serviced. You might go into that branch every month to make your payment in person. And the institution you got the loan from would never even consider selling your loan to a different provider. Fast forward to today, 2026, none of what I just described is true. The consumer lending industry is incredibly fragmented and modular. It's much more efficient, it's much more specialized, but it also carries a set of risks and challenges that I don't think we've fully wrestled with. So that's what this series is about, Lending Unbundled, and what that means for consumers, for lenders, and for the market overall. I am delighted to be joined in this endeavor by Bjorn Nordman, who you've probably heard on the podcast, and I've done some virtual events with of TruStage. Bjorn, thank you so much for doing this series with me. I'm delighted to have you.
Alex, thank you so much for having me. I think, as you said, this market today that is out there for all the consumers to understand so extremely easily is really interesting. And obviously, I mean this facetiously, where we have so many lenders, we have fintechs, we have regulatory requirements, we have consumers all over the place, and it is really difficult to understand. So I'm excited about this podcast series to hopefully unbundle some of the things that people have on their mind with questions that are out there of what should I do? And both from a consumer side as well as from the financial institution side. And I think we're going to have some really good guests that can help with that. I'm excited about our first one today coming on. And I think from my perspective, this is it couldn't come at a better time.
That's how I feel too, Bjorn. And it's well said. We're going to unbundle the unbundling of consumer lending, right? We're going to get to the bottom of how this happened, why it happened, what it means, what it looks like. I mean, as you illustrated, I kind of think of it a little bit as like the Wild West of our current moment in consumer lending. Like, there's a lot of danger, there's a lot of confusion, there's a lot of uncertainty, but there's also a lot of like value and rewards to be gotten, right? I mean, we are all, I think, benefiting from a great deal more specialization in consumer lending than we used to, and a great deal more competition for our business than we used to. And so, our desire, I think, in this series is to not paint the current ecosystem that we have either in an overly positive light or in an overly negative light, but to just talk about it as the system that we have, understand it, and understand the impact that it has, as you said, on financial institutions, which will be defining fairly broadly in this series, banks, credit unions, fintech lenders. We'll probably even talk a little bit about secondary market and private credit investors, the whole sort of ecosystem end to end, as well as obviously the end customer. And Bjorn, maybe you can give, since you'll be joining for all of the episodes in this series as my co-host, a little bit of your own personal background and your role at TruStage, just so that people understand the point of view that you'll be bringing to this discussion.
Sure. First of all, let me talk a little bit about who TruStage is, just for two seconds.
Sure.
I think depending on who you talk to, TruStage is a very well hidden secret. TruStage is very well known in the credit union world. Of course, we've worked with, so many credit unions. I think it's 94% of all credit unions over the last 90 years. But outside the credit union world, in my private circles, if I talk to anybody, they're like, who are you working for? And I tell them, they're like, never heard of it.
Yep.
Right. And so TruStage is 90 years old. I think we're protecting over 40 million consumers today. We are the second largest payer of unemployment benefits after the US government. And we're a mutual insurance. So from an overall perspective, being born out of that credit union world, we care about the end consumer. And so ultimately, it's how do we provide financial health, financial inclusivity, access to financial tools and to insurance potentially to consumers that may or may not traditionally have been underserved. That's what TruStage does. I'm excited. I joined TruStage about 7 months ago after having spent 31 years on the technology side, with the last 3 years before joining TruStage in Fintechs, selling to credit unions and to other financial institutions. Now being here at TruStage, it's really exciting because I get to be on the other side of not just providing the technology piece, but actually providing solutions that will help that consumer. Not necessarily help the consumer from a technology perspective, but when a consumer is in let's call it dire situation, is typically when they look to either financial institutions or to insurances to help them figure out, what does my financial future look like? How do I pay for my mortgage? How do I pay for my electricity, for my cell phone? How do I make sure that I can continue to feed my family? And so being at TruStage now is really exciting because I think we provide insurances to those consumers that ultimately really help in those situations.
Yeah, absolutely. I mean, a thing I like to joke about sometimes is, TruStage is like the oldest company that you've never heard of, right? Because it's been around for a very long time, incredibly well embedded within the financial services industry, plays a really key role, particularly from an infrastructure standpoint, as we're going to talk about in this series. But also, as you mentioned, Bjorn, has just a ton of great relationships and interesting connections across the ecosystem. And we're going to be leveraging that to bring some great guests to this series. So I don't want to tease too many for the remainder of the series, but perhaps you could let folks know who our first guests, who they will be listening to you and I talk to for the remainder of this episode is.
100%. I'm really excited for our first guest, Rodney Hood, the honorary Rodney Hood, former comptroller of the currency. Rodney was chairman, and I think before that, vice chairman of the NCUA. He was on the board of the FDIC. He currently holds numerous board positions and has worked in this industry for 30 plus years in all angles, right? He was a banker, then a regulator, then board advisor to CEOs of different firms, both on the banking and the fintech side. So just the amount of knowledge, the wealth of information that Rodney has from all these different angles is I don't think second to none. And so I'm really excited about having him on board on this podcast, and honored that he agreed to come on board with us.
Absolutely. I will add to your very good introduction that if anyone listening has not had a chance to meet Rodney in person, he is also one of the most genuinely nice, warm, inclusive people that you could ever want to meet. You will never forget a conversation with Rodney Hood, and you all get the privilege of listening to one right now. So without further ado, here is the remainder of episode 1 in our series Lending Unbound, where we are joined by the former chairman and former acting comptroller of the currency, Rodney Hood. Okay, Rodney Hood, thank you so much for joining us.
Thank you for having me, Alex. I'm delighted to see you again.
It is a delight to see you again, too, sir. I know we've had the chance to catch up on the road when we're out at events, but this is your first time on the podcast. Hopefully it won't be the last, but we thought you were the perfect person to bring on to kick off this series. The focus of our conversation is really, and not just in this episode, but across the whole series, is on the sort of increasingly complex lending ecosystem that we have in the US. And, we really, Rodney, wanted to get your thoughts because obviously you spent a lot of years on the regulatory side, both banks and then even more so with credit unions, helping to sort of supervise and regulate the financial industry. And, I was looking your history up before you came on the podcast, and I mean, you had a nice long tenure kind of watching the ecosystem evolve in the same ways that we've been talking about in this episode and that we'll be discussing in this series. So I'm curious if you could just kind of maybe give us a window into your observations when you were on the regulatory side about how the lending ecosystem and sort of the value chain that a loan goes through, how that evolved over your time as a regulator, and sort of what your observations were about the regulatory framework that you had in place versus how you saw the market evolving in real time.
Oh, gosh, you've given me a lot to unpack, Alex. What I will say is that in my 30 plus years, not only having worked in banking, but as you've referenced, an opportunity to work as the acting comptroller of the currency and to be NCUA chair, I've seen a lot of how the lending world has evolved. And the one thing I would say is that we are seeing it specialize more. When I think about lending, when I was a young banker and whatnot, you wanted to make sure that you were controlling the full outcome of the loan, from the underwriting to the pricing, all the way through the servicing and fulfillment. And that has since changed. And especially when I was chairing the NCUA, you may know this, Alex, because you and I often run into each other at Fintech events and digital asset types of activities. The digital assets in the fintech world has vastly changed the lending environment. And what do I mean by that? I mean that when we look at some of the existing models of regulatory activities that I may have inherited, it was built for a generation where the credit union originated the loan. It was totally integrated. That member walked into a branch. That member sat across from the loan officer. They probably knew each other from children playing sports together and all that. There was a paper application, and the loan decision was made. Loan was booked, as I mentioned, all the way to fulfillment. But what we're starting to see now is that with the specialization, or what some people would call fraying, there's so many different aspects that the regulatory regime, I don't want to say has not been able to keep up, but it's made it arduous at best, especially when you're going to have entities that have not had to go through a due diligence or a safety and soundness type of activity. And what do I mean by that? I mean the fintechs. Not that they're doing anything incorrect, but that examiner and our supervisory framework of the late 30 or 40 years has not really evolved to keep up with true times. So I think you're seeing a lot of catch up now. I think you are starting to see a lot of activity around third-party due diligence, looking at all the other people who are touching the loan. And while we're going to emphasize that, all the regulators, whether it be NCUA, FDIC, OCC, Federal Reserve, they all have issued the impact and importance of third-party due diligence. But what concerns me most, Alex, is that even though we're able to look at all the people who touch the lending ecosystem, who's most left out in the cold? And that would be the end user. We still lamentably live in a day and age where many times that consumer, that person who's gotten the loan, does not know whom to call, where to call. A lot of the information has been on the front end. And at the end of the day, that servicer, as I mentioned, is not the person who originated it. So it creates a lot of chaos and I would say confusion in the long run.
Yeah, absolutely. I mean, Bjorn, I know you and I have been talking about this a lot, especially on that last point Rodney made about the impact on the consumer, right? I mean, this fragmented ecosystem translates into a lot of confusion for that end customer.
Yeah, I would agree with that. I think the big piece that I have seen and continue to see is that question of what are we doing to gain the trust in the end consumer? From a full value chain perspective. We have so many different tools now. Every consumer has the ability to request a loan. They can request 5 different loans in less than a minute. And they potentially get multiple different answers depending on who they are requesting it with, what are the questions that they're asking, are they being offered additional components outside the loan? And at the end, I think the consumer needs to feel that trust in the financial institution to pull the trigger.
Well, and building on that point, I think that's a great point. I mean, Rodney, trust is this sort of nebulous concept, and yet I'm guessing, this is my guess, but you can tell me if I'm right or wrong, sitting in a regulatory seat, that's what you obsess over, right? Is the safety and soundness, this question of trust. Do people trust the system? And I'm curious if you can help illustrate sort of what the specific impacts of different policy mechanisms, whether it's regulatory rules or enforcement actions or even new laws that are passed, that have sort of impacted the shape of the consumer lending industry. Because a thing I think about a lot from a policy perspective is, which things did we sort of explicitly choose? And which things did we just sort of end up with because this is just how the market evolved? And I mean, maybe to give a specific example, I mean, obviously a lot of what we've seen with banks and with credit unions has been shaped a lot by the Great Recession and the financial crisis and the sort of regulatory response to that. And when I talk to policymakers today, a lot of them, their formative experience was watching the great financial crisis play out. And a lot of the lessons they took from that have carried over into sort of the post-crisis shape of the industry. So from your perspective, how do regulators' kind of policymaking priorities and kind of regulatory rules, how do they shape this structure that we're talking about?
That's a really good question. And you're right. I really was there dealing with the credit union system during the great financial crisis in 2008 and 2009. I would say that as a policymaker, we would say that some of the fragmentation that we're now seeing was a direct consequence of policy design in Washington. And some of it was, I would say, profoundly unintended. What was created through policy design was the creation of the Dodd-Frank Act and how that stood up the Consumer Financial Protection Bureau. I need to remind any of our listeners or anyone joining us today, the primary goal was protecting consumers after the catastrophic failures of the crisis. And I would say that someone who believes in safety and soundness, but also has a fidelity to consumer protection and making sure that our vulnerable borrowers are having access to fairness and equity and all those types of things, I would say that the goal of the agency was legitimate and necessary. But the compliance architecture that followed, I would say, was perhaps not intended, especially when you think about the sheer volume of reporting requirements and the compliance architecture that followed. It was expensive for institutions of all sizes to really comply with the reporting and the data requirements and things of that nature. And especially those smaller community-focused institutions, they just didn't have the ability to keep up with some of the demands. Of course, they tried. If you were a community bank with $2 billion in assets looking at the compliance infrastructure required to originate meaningful mortgages, you start doing the math, and for many institutions, the math pointed toward pulling back. So I think that with some of the institutions, we saw those unintended consequences. But confounded with that, I mentioned that is a policy design choice. But then there have been some other things, I would say, that were created that were unintended, and that was the advances that we've seen with technology, with some of the fintechs, with the fact that regulators began providing more opportunities for third-party service providers. That brought in new entrants into our playing space, cloud computing and APIs that dramatically lowered barriers to entry. And then finally, we mustn't forget the consumers. They, because they've been exposed to technology, because they walk around with their handheld devices, they really want to have their consumer services needs met in the same manner that they can go online or go to their phone and have a delivery reach their home in 30 to 45 minutes. So consumers expected financial services to work like other digital experiences, fast, personalized, and available around the clock. So I would say fragmentation wasn't totally created by regulation, but it did come as an offshoot of specialization that we saw with those new entrants. But good policy should recognize that specialization creates efficiency, but it also creates interdependence. And as I often like to say, Alex, risk doesn't disappear because it moves. It simply changes addresses.
Well, you're on the right podcast for that particular statement, Rodney. And I know, Bjorn, Rodney is speaking your language here. You work with a lot of those fintech companies, and I think it's a good point that even though greater regulatory requirements or greater sort of, I sometimes hear it referred to as just kind of the paperwork side of compliance, just like lots of checking the boxes and lots of having to do proactive work, that might have reduced the incentives for banks or credit unions to sort of play in certain areas versus just go, you know what, we'll partner, we'll find someone else to do this. But I do think the point Rodney's making about fintech coming in and offering like better products and services is also very relevant to this story, right? I mean, that might have cracked the door open, but once consumers got their hands on better lending experiences or faster underwriting or better pricing or whatever it is they were getting from these specialized providers. I mean, Bjorn, you work with these companies on a daily basis. Like, they provide a lot of distinct value separate from just having this little like space in the industry carved off by regulation.
Yeah, I agree. I think Rodney touched on that point. Alex, I think you touched on it as well, that we're in an environment now where consumers are spoiled by instantaneous deliveries, instantaneous gratification. And because of that, I believe consumers expect the same thing from their financial services providers. Is it a bank? Is it a fintech? Is it an insurance? I personally think about myself as a consumer and the scenario of it might take me 6 to 8 weeks to decide on which car I want to buy or something else that's a bigger expense. But then once I've made that decision, I want it in my driveway the next day, which means I can't wait for my lender to wait to make a decision for 5-6 days. I'm going to try and find somebody who can actually give me that money so I can get that gratification. And I think that's where I've seen a lot of fintechs really move the needle for a lot of financial institutions to hopefully catch up to that same speed level.
Well, it's interesting that you mentioned that because I've always had this theory, particularly with lending, that from the customer's perspective, a loan is a very different product than from the provider's perspective, right? So if you are a bank or a credit union or a fintech company, it's really tempting to think like our product is the most important part of this to the customer. Like, our product is central because you want to believe this, right? Like, I am building a product that really matters in the lives of my customers. And that's true. But I think the caveat to that is a loan is always something that enables you to get something you want, right? No one gets a loan just to get a loan. You get a loan to get a car or to buy a television or to buy a house or to pay down debt. Like, you get a loan for a specific reason. It's an enabling technology. It's an enabling product. It's not the product itself. It's not the outcome that somebody wants. And so I think your example, Bjorn, of someone going to shop for cars and they're putting all this work in advance. Well, they want the car. That's why they're dedicating all the extra time and emotion to that. But when they get to the point of actually needing to buy the car, yes, suddenly they need an auto loan. But in that moment, they're not looking for this large, expansive conversation about all the different things you could do with an auto loan. They're not looking to waste a lot of time. They want to get the loan, get back to the dealership, get the car, and have it in their driveway the next day. And I think, it's interesting because, Rodney, I want to come back to you. That contrasts with a lot of the traditional, not just like economic models that exist in banking and on the credit union side, but even just like the philosophy of how they do business and like their approach to working with customers or members. I'll give you an example. On the credit union side, obviously, to get a loan from a credit union, you have to be a member of that credit union. Now, membership requirements have sort of widened over time, and there's more sort of flexibility built around that than there used to be. But you still have to become a member. And I've been really fascinated to see how credit unions have sort of fit themselves into this emerging ecosystem where it's like, you know what? The shopping process for a car, it doesn't go through the branch anymore. It goes to the dealership. They control the experience. And only for a brief moment in time is someone open to a new financial relationship just to get that car. And so we've seen a lot of changes even on the credit union side of like, yes, you can open up a share account and put $1 into it, just as a part of the digital onboarding process for credit unions competing in that indirect auto lending channel. So, I mean, Rodney, I guess I'm curious, when you would talk to credit union executives about how the market was changing, how are they reacting to that? Because that is technically, legally, they're still getting new members, but the context in which those new members are coming in, the relationship that the credit union has with them, it's completely different than it was in a different context. Like, how did they sort of work through that challenge?
That's a really good question, Alex. They've had to evolve, and you're right. Typically, the credit union lender, they knew that person sitting across the desk that they were approving, as I mentioned in my opening, that they probably had kids that played together. They saw each other at Rotary. And now you open the dynamic of technology, and through the indirect auto lending portfolio that they have, they've had to be really creative in how do they manage those relationships. So it's not just enough to welcome that borrower or that auto borrower into your credit union, but you need to make sure that you're getting to know them. How do you do that? You're looking for opportunities to cross-sell and to bring them into additional products. As I often would tell the leaders, you just don't want to lend or lead with one product where once that loan is paid off, you lose that relationship. So I think credit unions, it's important that they look at things that I don't know if you've heard them mention this, but I still, even though I have overseen those institutions, they still don't talk about cross-sell opportunities. And I think that that's something that credit unions need to follow. I think the other financial services providers, and that's looking at cross-sell institutions. And you know what? In most products, in most banks, it takes a minimum of 6 to 8 products to have with that individual before they think of going to another institution. So yes, if you're going to have that auto loan that's maybe 30 to 50 basis points below that of your competitor, what are the other things that you're going to do to build that relationship? And I think when I talk about technology and I talk about fintechs, Alex, I created the Office of Financial Technology and Access when I was at NCUA, meaning that I want them to avail themselves of these tools. Where am I going with that? If credit unions are going to embrace fintech partnerships, let's use that technology to not just go deeper in understanding the needs of those auto borrowers, but how do you go about anticipating them, not meeting them, but anticipating them? That's how I think they can use technology strategically. Or to your point, they've just gotten an auto loan, but no other relationship.
This episode is brought to you by TruStage. If you're a fintech lender leaving non-interest income on the table, TruStage payment protection solutions are designed to change that. They offer compliant, scalable protection directly in the lending experience, which means better repayment outcomes for your portfolio without any added operational complexity. TruStage has been helping people make sound financial decisions since day one, and that same thinking shapes how they build for lenders. Visit TruStage.com for more. Yeah, I mean, the difference between those two things is honestly the difference between survival and not, right? I mean,
exactly.
Like, these new channels, these new partnerships, they are a way to get in front of new customers or new members. They are a way to sort of add an additional revenue line. Like we've seen a whole bunch of growth around banking as a service where banks are, putting their charters sort of available to other parties to build on top of. But like those are also very fragile business lines, right? To your point about indirect auto, like once the loan is up, if they don't know who you are, right, they're just making a payment every month. They're not hearing from you. They're not connecting with you in any other way. Then like the downside of this modularity comes back to bite you where easy come, easy go. And then suddenly they're gone. Bjorn, I think in some ways it also comes back to what you were pointing out earlier about trust, right? I mean, when I think about what kind of competitive differentiation survives in a more modular fashion, I come back to this question of like, who do you call when you have a problem, right? Like accountability in some senses. And, it's interesting because I think it depends on the type of product that you're looking at in financial services. In some senses, I think actually other product groups inside of banks or credit unions have an easier time with this, right? If it's payments, you have to specialize in trust and accountability because stuff's going to go wrong all the time. Someone's, debit card is going to be stolen. There's going to be fraudulent transactions. Someone's going to have a chargeback. Like payments gives you a lot of at-bat opportunities to build trust and to sort of demonstrate accountability to the customer. Deposits is the same thing because they're transacting all the time. You're like trying to earn trust. Lending is hard though, because when you're lending money, you obviously have a moment to build trust when you're originating the product. But after you originate it, assuming that you get the auto payments set up and it just goes into servicing. I mean, I know a lot of institutions, both fintech companies and banks and credit unions, that sort of treat servicing as just like, if it's not broken, don't touch it, don't do anything, don't breathe on it, just like leave it alone and let it continue to do its thing. And I don't really think that's the right approach, but I also think a lot of times lenders just don't think creatively enough about like, what can we do to build trust and accountability post origination in case like the customer has problems, in case something comes up. What's been your observation, Bjorn, on that side of the customer journey?
Yeah, I wholeheartedly agree with what you said. And I would add one more thing to that before we go into post origination.
Yeah.
Assuming it gets funded, because
Right.
there is the aspect of a loan being declined.
Totally.
And I think that in that process is where the beginning of trust starts.
Mm-hmm.
I think we talked about this on a previous podcast or a previous conversation, that a decline that is not understood by the consumer destroys the relationship faster than a slow approval. So I think that's number one, is educating the frontline staff and therefore then educating the consumer why a decision was made, what was the basis of that decision, and potentially helping them to change the outcome the next time they ask for a loan. So I think that's number one. And then I think the second thing that I've seen is once a loan is approved, and let's assume you're in month 4, month 6 of payment, it all is working well. Well, now the rates change,
right,
on a dramatic scale. How many times has your bank, your credit union, your lender, whoever it is, reached out to you and said, "Hey, Alex, guess what? Rates have dropped dramatically. Give us a call. We might be able to give you a better rate."
And I can answer that question for you, Bjorn, for myself personally. Zero times has that happened. That has never happened to me. But it's a great point, right? Like I'm out there living my life. And Rodney, I'm sure you saw this, right? Because obviously you were on the regulatory side before the pandemic, kind of like through the pandemic. Like this was like a very dramatic example of this. And I'm so glad Bjorn mentioned it. Like, we had all these things happen, and it was a really interesting sort of stress test, I think, in some ways, of these processes and these systems for banks and for credit unions. I remember talking to a bank who was telling me that during the early stages of the pandemic, they got a bunch of calls to their call center from loan customers who were like calling, and they were like, it was like 800% more than we normally get, or some just like enormously large number. But they were saying the thing that was weird about it was most of the time when we get calls to that loan servicing part of our business, the calls are always like, something has happened to me. I've had a problem and now I need to fix the problem. I lost my job. I've missed a payment. I'm about to miss a payment. Like the bad thing has happened and now I need you to help me kind of dig my way out of it and figure out what to do. And the people who work in the call centers are like trained for that conversation. They're like ready for that conversation. And they said the thing that was so instructive about the kind of COVID era surge in calls was it was very early on when we were all scared. We didn't know what was going to happen, but no one had actually like lost their jobs yet. And so all the calls were like preemptory calls. And so they were saying that like even the conversations people were having in the call centers were weird because it was more about helping the customer sort of understand, well, here are what your options are in case that happens. Here are the things you should think about. Oh, yeah, rates have actually gone down, or we think the Fed is going to cut interest rates. That might be a good time to do X. And so it became much more consultative than it was like a fire department trying to put out fires. And I think that illustrates kind of, Bjorn, what you're talking about too, where it's like, that's the kind of muscle that like banks and credit unions just haven't built up nearly enough. But Rodney, what did you observe, especially during that time, in terms of like this accountability to the customer?
Well, what I observed was that the regulatory agencies, we were all working to provide regulatory flexibility, meaning encouraging the banks and credit unions to do loan modifications and forbearance, reminding them that they had a duty to work with those borrowers. No one wanted to see foreclosures. No one wanted to see cars repossessed. So it was important for folks to note that all of the financial regulators gave guidance and information that was disseminated not only during the pandemic, but also you see vestiges of that when you see the government shutdowns, especially closer to Washington and beyond. A lot of those particular credit unions that have the government workers in their field of membership, they reach out to them proactively, letting them know of loans and things like that they can be sort of used to help them sort of have resources during the times when they're not getting a paycheck. So the regulators did not sit idly. And I'm very proud of the fact that all of us, whether it was the NCUA, FDIC, OCC, Federal Reserve, during the pandemic, the guidance that was out around working with the borrowers, and especially when we were working with Congress for some of the relief measures. So that worked out well. So the regulators were encouraging. And the main thing, though, was making sure that those who were availing themselves of what we're encouraging them to do so, that they were at least able to document, just so that the examiners and others can understand what had taken place.
Yeah, I mean, it was such a good example, I think, of the time of just like, oh, actually, it turns out we have a lot of different tools in the toolbox, and we mostly maybe don't use them, or we don't use them proactively, but they're all there. And yeah, I mean, the feedback kind of matching up what you said, Rodney, is I think a lot of customers were kind of thrilled with like what that actually looked like when I needed my bank or my credit union. Turned out they were there for me, and they had a whole bunch of different options. I want to wrap up before I let you guys go, talking a little bit about emerging technology, because obviously a lot of what we've been talking about, the benefits of a more modular ecosystem, as we've been saying, like the customer has more competition, they have more options. Bjorn, going back to something you mentioned before, like the odds you're going to get approved are probably higher if you have lots of different lenders competing for your business, or even, doing second or third look financing if someone can't approve you. The downside is that it's just much more fragmented, as we've been talking about, and much more confusing. I do think that emerging technology has the potential to sort of stitch together some of these different silos and make it a little bit more of a cohesive experience for the end customer. And the two that I would cite just as examples are kind of open banking and sort of data portability more broadly, right? So this idea that okay, I may not work with just one provider vertically integrated anymore, but my data can in some senses be extracted from all the places that it is and vertically integrated. So my data profile can be vertically integrated, even if the rest of my relationships aren't necessarily. And then the second component, which we're obviously right in the middle of right now, is everything to do with AI. And I think AI is interesting to me for a bunch of different levels on this, but one of them is its ability to help customers kind of navigate through this complexity, right? One of the things I worry about is just easy questions like, who do I call when I have a problem? Who do I direct this to? Even really, really simple questions. Like I find myself asking this a lot, where I'm like, what's the name of my mortgage servicer again? Like, I don't remember my mortgage servicer, and my mortgage gets resold every couple of years to someone new, and I just set up auto pay and I forget. Like, there's just a whole lot of complexity that I feel like AI or agentic AI can potentially help us navigate. So I'd love to get both of your takes on this. Bjorn, why don't you go first? What are you looking at in terms of advances in technology, kind of plug in some gaps here?
I think it's an interesting question, to the point where, as you said, we're there are more and more pieces to this ecosystem. And because a lot of the players will come forward with a solution, and somehow I feel every time you hear a sales pitch, it's always unique.
Yeah.
Right. And I hate to speak in absolutes, both always and unique are obviously absolutes. But you hear it constantly. And because the statement is out there of our solution is unique, then the second question becomes, well, how do you integrate with others? How do I make sure that, as you said, you have data portability, that a financial institution actually has let's call it a 360 view of their client, or that I, as a consumer, have a 360 view of all of my financials? I have to go to different tools where I have to authenticate against all my financial institutions and have to figure out what is happening out there, right? And so I think AI and platforms in general that will enable the holistic view in both directions, as approved, right? I have to give my consent wherever it is required from a legal and regulatory perspective. But anybody who can give me that view can really entice me to start having a conversation. And wherever AI can happen, is it with data normalization? Is it with data integration? Is it with analytics behind what these massive amounts of data actually are supposed to tell me? Can I do something better? I think that's where I see kind of the future going, where I could say, I'm logging on somewhere and go, all right, tell me the best loan for this type of scenario today. And then I can go and apply for it. Or even to the next point of financial literacy. Should I apply for that loan in the first place? Based on, am I financially sound before getting the loan? Or do I try and make myself financially sound once I have the loan? And is the loan enabling that?
Yeah, I think that's a great example. Rodney, what would you add to that from your perspective on some of these emerging technologies?
Well, first of all, I want to just agree wholeheartedly with Bjorn's comment about financial literacy. That is so critically important. I believe that Americans still do not understand all of the components of good, sound financial health. That's evidenced by 40% of American households unable to obtain a $400 loan in an emergency, or the 65 million households that are what we would call credit invisible. So I want these individuals to have access to open banking. I want them to have access to tools so they can better prepare for their financial future. But without financial literacy, these individuals are going to continue to be left behind no matter how great the emerging technology is, whether it's agentic AI or whether it's generative or whatever the activities are. How are we bringing financial literacy to bear? So I give a lot of talks. I was just recently in Europe and later in the UK talking about what needs to be done. And I think a lot of our European counterparts are really further along when it comes to open banking. So I think that we perhaps are playing catch up here with that, gentlemen. But with that being said, I think this is one of the most exciting, transformative periods that we have been in since online banking came into existence. Because if properly deployed, yes, open banking is going to equip that consumer with the technology and the tools that they need so they can compare loan officers. They can negotiate repayment options. They can detect fraud. They can monitor their financial health. I talked about the need for financial literacy. Well, with some of the technology, that can be embedded into some of the technology they're using through their phones. So I think that there are a lot of things that can happen. Also, I think the technology can help not only with negotiating loan terms, but also can help prevent delinquency before it happens. There can be those real interventions. So I think that's really exciting. I'm also excited about the fact that AI is being used a lot now to improve loan decisions. The credit unions and banks that are using it. I'm on the board of a company, which I will not do an ad, but I'll just say the tools can be used without any degradation or diminution in credit quality. What happens is a lot of the traditional scoring mechanisms of yesteryear, they were leaving people out because those scoring mechanisms had biases built in. I was a young banker 30 years ago when I couldn't figure out why two borrowers had similar income, similar payment histories. One borrower had a FICO score that was almost 100 points lower than the other. What would have contributed to that? The scoring model assumed that the one borrower who didn't go to a Main Street bank but went to what we call a check cashing, or they went to one of these brokers, that was the loan shop that was in their neighborhood. That individual did not know that that was bad, that they should have gone to Main Street or Wall Street and not that person that had an ability to grant a loan. So the scoring model assumed the worst. AI, you can build in against those biases to make sure that you're getting nicer, consistent decisions that are going to be made. So I'm very excited. But as I show my excitement for AI, I want folks to recognize it should not at all augment human judgment. It should augment human judgment, but it's not going to replace accountability.
Sure.
We still need to look at fairness, transparency. To all the folks who are listening, from my regulatory point of view, make sure that you have explainability. Make sure that you're protecting the data. What we often see is that many banks and credit unions alike, they're embracing AI, but they're not going through the governance protocols. Are the boards making the decisions as to how it's going to be used? Are the boards of directors actively engaged in working with senior management to know where is AI being deployed? What are the use cases? And is it being actively used for decisioning? It's supposed to help assist, but at the end of the day, there does need to still maintain accountability. So, but I would just say that the technology is continuing to change, but public trust is not. So we still need to make sure that we are making sure that whatever tools we're using, we've not frittered away trust that's been created.
I think that ties us back to what we were talking about at the very beginning of this conversation, just in terms of trust being that enduring thing that cuts across this increasing specialization that we see in the market. Rodney, final question, and then we'll let you go. You've been very generous with your time. If you could just sort of wave a magic wand and change one thing about the U.S. consumer lending market right now at this moment in 2026, what would it be?
Oh, gosh, I have to stick to one thing. It's not every often that I get to wave a magic wand.
I've granted you this power for one thing, Rodney.
What I'm going to say, and it's going to surprise a lot of folks since I am a former safety and soundness regulator, Alex, if I could wave a magic wand, I'm not going to eliminate risk from the credit system. What I would do is I would eliminate unnecessary friction and information asymmetry. My vision would be a consumer-centered credit ecosystem where every American has a secure, portable financial identity that they can control and be full participants in the economic mainstream. That is what I would do with my magic wand.
That is a great answer. And Bjorn, I don't know if I can speak for you, but I think that's an awesome place to leave it.
Yes. Nothing further to add.
Awesome. Okay. Well, gentlemen, thank you very much. This was a wonderful way to kick off this series. I really appreciate it. And Rodney, we'll have you back on the podcast many, many times in the future. Thank you, sir.
Thank you. It was lovely being with you both.
Thanks, Rodney. Thanks, Alex.
Thank you.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.